and welcome back to my channel. If you are new here, igama lam nguYolanda, and this is Property Talk with Y'alls, where we talk all things property and equip you guys to make the best property investment decisions. Basically, you learn from my mistakes. As our fave Maya Angelou always says, when you know better, you do better. And this channel is all about making sure that you guys know better. So we are just going to get right into it. And as you guys can see from the board, we're going to do a bit of maths today. Nothing hectic. It's not higher grade maths. Just a bit of addition, subtraction, division. And basically what we want to do is we want to calculate the cash flow and cash on cash ROI on my first property that I bought all the way back in 2017. Now, I'm sure you guys already know, well, most of you, if you've watched my other videos, know the story that I relocated to Johannesburg in 2016 and I bought this property in 2017. The thing about buying your first property is that it's always an emotional decision, right? When I bought this property, I wasn't thinking cash flow. I wasn't thinking ROI. I wasn't even thinking investment at that time, right? I was just tired of renting and I thought to myself, I want to own property while I'm still young. I want my name on the title deed. So this was a very emotional decision. It was based on the area. So at the time I worked in Sandton, and if you guys don't know, Olivedale is a small suburb between Randburg and North Riding. So I think it's perfect for like a young professional that works in the Sandton area but obviously doesn't want to pay the steep prices of rent and live in Sandton. It's about a 10-kilometer drive to Sandton, so about a 30-minute commute, so not bad. And basically I was just looking for a new development, something that's aesthetically pleasing. I don't compromise when it comes to the place I stay, and basically that were the main factors of my decision. Somewhere nice, somewhere convenient, and not too far from work. So, and that's how I bought my first property. So now that I know better, and I've started venturing into this world of really understanding what it means to invest in property, educating myself, learning from others, engaging with other property investors, it's really just made me realize how important cash flow is when it comes to property investing. And I understand that cash flow is not the only determining factor that a property is a good investment. Of course, there's natural appreciation on the property and the equity that you build on a property, but I think cash flow is a very good start just to understand if you're able to make money from the property from day one. So basically this is called the 4 square method. As you can see, there are 4 quadrants on this board. I'm not going to take any credibility for this. Some very smart people came up with this and I'm just reapplying this to my own property. And basically you have your income in one quadrant, you have your expenses, your cash flow calculation, and your cash on cash ROI. So I'm going to start with the easiest, which is your income. And obviously the most obvious income is the rental income that you receive on the property. So for this specific property in Olivedale, I receive a rental income of 8,000 Rand. Other incomes you can consider would be your utilities. In my case, I said 0 because it's a prepaid system. So the tenant pays for his or her own water, electricity, and gas. Other incomes to consider would include your storage income. So if you stay in an estate where they have extra storage space that you own, you could rent that out to someone else on a monthly basis. And as well, if you have additional parking maybe that you don't use or your tenant doesn't use, you could also decide to rent that out to someone for a monthly fee. So in my case, because the only income I receive is rental income, my total income on this property every month is 8,000 Rand. Now we get to the long list, and we don't like this list that much because this is money leaving our bank account, and these are our expenses. We'll start with the most obvious one, which is your bond repayment. Now my bond repayment on this property is currently 7,018 Rand. I have a variable interest rate on my home loan, which means that it's linked to the prime, right? Prime interest rate. So if interest rates do go up, this amount will go up, and if interest rates do come further down, then this amount will also come down, but currently it's at 7,018 Rand. The next expense on the list are your levies. Now if you stay in an estate or a complex, you will have to pay levies. So basically these levies are to cover the upkeep and maintenance of the complex or estate, security if there's a guardhouse and you guys have guards on the estate, and it also covers insurance of your physical property, like the physical building. Then we move on to the rates. So your rates are obviously dependent on the area, and in my specific area in Olivedale, the current rates I pay monthly are 586 Rand. So levies, which are directly paid to the body corporate in the state, I pay 1,224 Rand. And then rates, which I pay directly to the city of Johannesburg. As I said, this is dependent on the area. I pay 586 Rand a month. So the next expense on the list are your taxes. Now you guys would know that if you own an investment or rental property, that is additional income, or that is income that you are receiving, and that income is subject to tax. But I did explain that you are able to subtract some of the expenses to manage your property from that income, and basically whatever the difference is between the income and your expenses, you're only taxed on that amount. In a case where your expenses on the property are higher than the rental income that you receive, i.e. you're not making any cash flow, you're sitting on a negative, then SARS will not tax you, right? Because you can prove to them that I'm actually not making any money on this property. Cool. And then we have insurance. So if you are in a complex or an estate and you pay levies, I did say that insurance is included in the levies. But of course, if you have a standalone house, you will then have to insure the physical building, your physical property, and you then consider what the insurance cost is, because that would be an additional expense that you have to pay. Then we get to repairs and vacancy. So basically, guys, if you own a rental property, somewhere down along the line, in my case, I bought in a new development, so I haven't had to do any major repairs on the property. But somewhere down the line, something will go wrong, and you need to make sure that you have those additional funds set aside to be able to fix whatever the repair is. So in my case, I put 0 because I already have an emergency fund set aside, which is equal to 4 months rent for this rental property, so that if any sort of emergency comes up, then I'm able to sort of utilize that money to sort out the repair. The same for vacancy. You cannot guarantee that you will always have a tenant every single month, right? There might be 1 or 2 months in a year where, we just experienced COVID, people lost their jobs, people couldn't afford to pay rent. So you have to factor in sort of a percentage of vacancy for your property. You can look at your area. You can get some data to say that, in this specific area, you are likely to, experience 5% vacancy in a year, which will probably be like a month. But you have to put money aside to make sure that in a case when your tenant doesn't pay, you are still able to cover all the expenses, right? Because if this 8,000 Rand income does not come in, I am still liable as the owner to pay all of these expenses, right? So you need to have a buffer. And the reason I wrote 0 there is because I already have an emergency fund set aside for such instances. But if you don't, you would have to at least save about 5 to 10% of the rental income. So maybe about 800 Rand, 400 Rand, between 400 to 800 Rand for repairs, and between 400 to 800 Rand for your vacancy, until you build that emergency fund, so that if shit hits the fan, you are prepared, okay? You are prepared. Remember, guys, renting out your property is a risk, and you need to make sure that you always have the money to pay your expenses every month. And I feel like when people list down their expenses, they forget to include the repairs and the vacancy, right? There might not be obvious ones, but these are very, very, very important to be able to limit your risk on your rental property. The last one is property management. So if you have an estate agent or an estate agency that is looking after your property, you will have to pay them a monthly fee, which will be a percentage of the rental income that you receive. So in my case, I manage my own properties. So I deal with the tenants myself directly. If I need a new tenant, I advertise myself directly. So I'll go and put an ad on Property 24 or private property, and I do all of that myself. It is quite a strenuous job, and I foresee in the future, if I have more than 2 properties, then I will probably have to look at getting property management just to take that stress off of me. Cool. So with all these expenses I've mentioned that are applicable to me, the total then goes to 8,828 Rand. Cool. So remember, the income I receive is 8,000 Rand. All my expenses on the property are 8,828 Rand. So this is when we come to our cash flow calculation, right? And what is cash flow? It's simply your income minus expenses. And you guys can already see that my income are actually higher than my expenses, right? So cash flow is my 8,000 Rand income minus my 8,828 Rand total expenses. And I am left with a negative cash flow of 828 Rand. This means that I need to supplement an extra 828 Rand to cover all my expenses on this property. The rental income I receive is not enough to cover all my expenses. Now, in my previous video, I did mention that the negative cash flow on this property was about 500 Rand, but that was before there was an increase in the levies. So the levies actually did increase from the 1st of April, which now means that I'm even more negative on my cash flow, right? Before it was about negative 550 something. Now my cash flow, because the levies have increased on the properties, my cash flow is now sitting at negative 828 Rand. Cool. If we see all the things that determine my cash flow, right? So my rental income is likely to increase over time. And as my rental income increases, this means that my cash flow will increase, and eventually I should move from a negative cash flow to a positive cash flow. But bear in mind that all my expenses are also likely to increase over time. So it's not just your income, right? But what you want is you want to stay or at least buy in an area where the demand is so high that your rental income is likely to increase at a faster pace compared to your monthly expenses. And that's how you'll be able to move from a negative cash flow to a positive cash flow. I also did mention interest rate. So if you have a variable interest rate on your home loan, again, if the interest rate goes down, your expenses go down because your bond repayment goes down. But at the same breath, if your interest rate goes up, your bond repayment goes up and your expenses therefore go up. There are a couple of things that determine this cash flow calculation, and it's either likely to increase or decrease over time. But I think the biggest factor is the rental income, and just being able to understand what the rental income in your area does. Does it increase just based on past experience? Does it increase by 4, 5, 6% every year? So okay, in 2 years' time, I'm likely to earn an income of 9,000 Rand. Therefore, I'm likely to then have a positive cash flow. Then we get to the last quadrant. And basically what this quadrant calculates is your cash on cash ROI. What is ROI? Your return on investment. In this case, what would your investment be? Whatever money like your own money you put into the purchase of this property. So we're not talking about the bank's money, because that's money that you're leveraging. It's not your money, and that's money that the tenant is paying off. We're talking about money that you put yourself or you invested in the purchase of this property. Okay, so some of the things that could be part of this investment or money that you put in could be a deposit, right? So if you put in a deposit in the property you purchased, you'll have to note that down. Now, in my case, I did not put a deposit when I purchased this 1-bedroom apartment in Olivedale. The other cost would be your bond registration. So you have to pay for your bond to be registered at the title deeds office. And in this case, this was the only cost that I had to pay to purchase this property, right? And it was about 15,000 Rand. Then you have your transfer fees and your transfer duties. Now, with your transfer fees, this you have to pay the lawyers in order for them to transfer the property from the previous owner to you, who's now the new owner. But in my case, because I bought a new development and I bought the property directly from the developers, I did not have to pay transfer fees. And then we also have transfer duty, which is just tax that you pay on purchasing a new property. But you're only liable to pay transfer duties if the property you purchase is over 1 million rand. And in my case, when I purchased this property, the price was 829,000 rand. So therefore, that meant that I was not liable to pay transfer duties. Because I bought in a new development, no transfer fees. Because the value of the property was 829,000 rand, which is less than a million, no transfer duties applicable. So the only cost I had to pay is the bond registration, because I did not buy my property using cash. I had to get a bond. So therefore, my bond has to be registered at the title deeds office. Cool. So that means in total, my investment, the money that I put, my own money, to purchase this property was 15,000 rand. Now, basically, we want to know, how hard is that 15,000 rand working for you, Yolanda? I could have taken that 15,000 rand and put it in the stock market. I could have taken that 15K and put it in a market link bank account, right? And I'm expecting to get some return on it. So I want to calculate, how hard is this 15,000 rand that I put into purchasing this property working for me? And in this case, it's not doing anything actually, because I am not even making a positive cash flow. In order to calculate your cash on cash ROI, basically you would need your annual income or your annual cash flow on the property divided by how much you invested into the property. In my case, I am making a negative annual income. So basically every single year, this is a negative. Every single year, I am losing 9,936 rand on this property. That's how much I have to pay every single year. Right? I invested 15,000, but I'm losing 9,936. So basically, if we calculate the ROI, 9,936 over the 15,000 rand I had initially invested of my own money, I am losing 66%. I am losing 66% every year. This property is taking money away from me. If I took this 15,000 rand and put it in a market link account, which will probably give you a 2 to 3% return on your money on a yearly basis, this money is better off in the market link account than in this property investment deal that I made. Now, I understand that it doesn't just end here. I think with the 4 square method, it just gives you a good indication if this property is a good investment or not. But remember, there are so many other factors you have to consider. So you have to consider the natural appreciation of the property and the equity you build on the property. So for example, if I sold this property today, has this property appreciated over time? What is the value of the property, and will I make a profit? Or if I hold on to this property for another 20 years, what will the value of this property be, and will I be able to make a profit? So you also have to consider that. But bear in mind that I could hold on to this property for 20 years. It could appreciate over time, but if I'm never able to make a positive cash flow, it means that every year I'm losing money. Yes, it's appreciating over time, but I'm losing money every year. Like, I have to put money into that property, right? So basically, I wanted to show you guys how I am losing money every month and every year. But I think with the 4 square method, this is something that you can use before you decide to purchase an investment property, right? This is all information that you can get beforehand, perform this calculation, and just see from the get-go, does this property make sense? Does it at least give me a positive cash flow? And if that cash flow is positive, what is my cash on cash ROI versus the money that I invested? This is not all the work that goes into, determining ROI or determining whether a property is a good investment, but I think it's a good start. And it's just a good gauge just to see whether this is something that I'm willing to explore and go further into understanding. What do I do? Because I'm losing money every month on this property. I'm losing money, almost 10,000 rand a year I'm losing on this property, So definitely something to think about. But also it has to be a holistic decision considering, the appreciation and the equity and the future cash flow analysis, right? dependent on how the rental income will increase over time. So yeah, thank you guys for watching this video. If you made it all the way to the end, I really appreciate it. I hope you guys have learned something. Please don't forget to like this video. Please press that like button. If you haven't already, please subscribe to the channel if this is the type of content you are into and you want to learn more about property investing. And if you have anything to say, please do comment down below. And yeah, thanks guys. Thanks for watching, and I will see you with a new video next week. Bye.